so Biden into Trump. The unintended consequences of that are jaw-dropping. And I think when you try to like take all these student loans and you're basically all these people had kind of like a very, very easy gravy train on the credit score situation. And now we're going to move all those people back very fast. And the unintended consequences of that are pretty startling. And you could see it in the buy now, pay later names, right? The Affirms, the Upstarts, and the tertiary lenders, your Synchronies, your Credit Acceptance. The underperformance is very dramatic versus the big financials. So the bottom line is yes, we are seeing a rising trend in kind of subprime credit risk. It's not as bad as 2008 yet, but it's the same type of things that we saw in 2007.
I'd love to get your thoughts on the very alarming developments in the bond market. A recent auction for US Treasury bonds saw quite weak demand, and it led to rising yields and investor concerns, quite understandably. And of course, the concerns focused on the nation's debt. The auction sold the bonds at a rate over 5%, which of course is the highest since 2020. And the 10-year yield also spiked. So the weak demand, along with other factors like concerns about geopolitical risks, we have several conflicts going on at once with no end in sight. And so those contributed to a sell-off, what appears to be in treasury bonds, and a general uncertainty in the bond market. And so how concerned are you about the $29 trillion US Treasury market? Is it actually running out of buyers? What is your take on what the latest events mean?
Okay, so if you're a global bond buyer, in the last 6 months, think of what you've been through. In the first quarter of this fiscal year, 25, which was October to December, that's this fiscal year, the Biden team jacked up essentially a $1 trillion deficit spending, a little bit under that, but in just 3 months. So you're running a pension fund in Europe, and you just saw that. Then Trump comes into the Rose Garden, uh, I guess in early April, and hit the global investment community over the head with a big tax increase through tariffs. And then he walked it back and forth. And then he's in the Oval Office with Elon promising a balanced budget. And then a month later, he's essentially sitting down with the Freedom Caucus, which is the most conservative fiscal group in the House. And he's basically trying to force feed them a big, like anti-Doge budget, right? Like the complete opposite of Doge. And then Elon Musk leaves the White House, in this week or so. So if you're a global bond investor, the United States looks a little bit like 5 or 10% more like an emerging market country, not like the United States of America. And this is bipartisan. They are smoking in the dynamite shed in Washington. What they are doing in the Congress, and this, remember, it's not Democrats, it's Democrats and Republicans. What Kevin McCarthy did a year and a half, 2 years ago on the debt ceiling was embarrassing. It allowed Biden to juice spending. And just think, we had a big fiscal expansion in that deficit spending in the fourth, I guess in the first quarter, and then we had 100 basis points of rate cuts, okay, from the Fed, and now we have another potential $1 trillion of capex coming into artificial intelligence.
Mhm.
This is a potentially deadly cocktail for inflation. Unintended consequences are piling up, and our congressmen in our Senate and in the House, they're just smoking the dynamite shed, and they're not going to learn their lesson until the bond market slaps them upside the head, and that's probably going to happen later this year.
If you had to pinpoint the causes or the main drivers of the sell-off in treasury bonds in May, what would those be?
Well, there was a day around the 7th or 8th of April, and I did a video on X, and it got 1 million views. And what I talked about in the video was that what Trump team has some different people in there. Howard Lutnick did not really think through, I thought, according to my clients, it wasn't very well thought through. And the formula that they used was probably not the best formula. And we were sitting down with at a hedge fund dinner in New York, and I had European allocators there. We had Canadian allocators, people that position billions and billions of dollars in bonds. And two or three of them said they basically are going to get fired unless they take down their dollar exposure. Because to make it simple for the audience, the United States of America, if you look back the last 50 years, there aren't many days where stocks are down, bonds are down, and the dollar's down on the same day, right? And we've had a lot of those types of days since April, since the Rose Garden. And if you're a global allocator, if you're a global bond investor, you've had this 30, 40-year period of real hardcore confidence in the United States. That confidence now has been shaken. And the most important thing in the book that we talk about, and we talk about the dollar and stress, and I want to make it very clear, we're not saying that the United States is going to lose its reserve currency status, not in my lifetime. But what we're saying is going into this year, the planet Earth was two standard deviations, long dollars, long financial assets. What we talk, so there's financial assets and hard assets. Everybody was table max long dollars, what we call two standard deviations more than the 30-year mean. And what's happening is global allocators are being forced to take down dollar exposure because of Biden, because of Trump, and that's going to go back to that 30-year mean. Right now, they're way up above it. And that gets back to why the auctions are starting to, if you look at the deterioration in the auctions the last year relative to previous years, yeah, there's a massive deterioration.
It seems that the global instability is now a new norm. As you pointed out, there's many things going on, and none of them seem to be very promising. Our viewers might want to hear from you about the recent Japan's bond auction. I know that it's also hitting very weak demand. What does it mean for US Treasury yields and for the global economic outlook?
Okay, so let's go back to the global pension fund. Yeah, this is not just a US thing. We've had global rates going. So for decades, Japan was what we call the global yield anchor, right? And we've had inflation, we've had bad fiscal policy in the United States and in Japan. And this is the most important part of this sit down is you have to think of the psychology of a bond investor. And the reason why that's important for people watching us right now is bonds impact your mortgage, impact your car loan. And so we got to remember what happens in the bond market is really important. And for the last 30 years, going into the last couple of years, but the last 30 years, 99% of the time, if there was any type of crisis in the world, whether it be Brexit or Lehman, your bonds on the long-term bonds might have made 10, 20, 30% because as interest rates go down, bond prices go up. It's really simple. So if you have say a 4% bond and interest rates go to 1%, that 4% bond for 10 years is now worth a lot more than 100 that you paid for it. So when interest rates go down, bond prices go up. And for a long time, investors around the world had the luxury of like, okay, the stock market's crashing. At Lehman, we lost 7 trillion dollars on stocks, and we made back 3 trillion on bonds. And during COVID, we lost close to 9 trillion on stocks. We made back 4 trillion on bonds. So that's been the case over and over again. Bonds have bailed out the stock market. What's happened since 2022, Lena, is really blood curdling because it keeps happening. So if you think of the big drawdown since 2022 in the stock market, We had like a 30% drawdown there or so, 25, 30, and 22. We had a drawdown in August of this past year. It wasn't that bad, but it was pretty interesting. And then we had a drawdown, a pretty substantial drawdown in the last since from I guess from February to April. In all three of those since 2022, the long end, the long-term 30-year bonds, your 10s, 30s, 20s, and in Japan and the United States basically didn't make you any money, right? So what global investors are saying is that why should I hold? And this is part of the decay in confidence. Why should I hold a 30-year bond if I'm not getting that kind of like traditional protection from recession risk or from the stock market going down? Since 2022, investors around the world have been losing money on stocks and actually losing money on bonds at the same time. And if you look around the world, that's the thing, Lena. That's the thing that typically happens into emerging market countries. So at the end of the day, the bottom line is the point we make in our book. The guys that are smoking in the dynamite shite in Washington have created a dynamic where the US has become like 5 or 10% more like like a Brazil. And our markets are starting to act when stocks go down, bonds go down, the dollar goes down all in the same day or week. That is shocking to the core. Your global allocators of big bond buyers are just shocked. And they're coming up with a portfolio right now. They want to own more Aussie dollars. They want to own the Korean won. They want to own some Bitcoin. They want to own some platinum, palladium, gold, silver. They're owning an entire basket of assets that are not really dollar exposed because they have to get down